Good evening, ladies and gentlemen. Michael Silva here. You're watching the Stock Market Brief Show, the show where we navigate the financial markets through the lens of technical and intramarket analysis. Today is August 6th, and it's been a wild time these last few days. In today's video, we're going to talk about going back to 2007, 2008, where we went into a higher volatility regime, where we saw Volmageddon, the big spike in the VIX, and what that might look and feel like now, and how it looks actually very similar. I'm also going to explain things that I do to protect my capital. We're going to analyze various signal charts and even dive into some mega cap stocks. All that and more. Make sure to subscribe and like if you haven't done so already. It's greatly appreciated. Let's get into it. Alrighty, ladies and gentlemen, welcome back to the show. Let's follow up on yesterday's video. And the reason why I want to follow up on yesterday's video is just to show you how important it is to understand these implied moves or expected moves in the market. Yesterday, we pointed out right over here, there's about a 68% chance that we'll close within this range and a 95% chance we'll close within this specific range. Here's the updated chart. And today we had our gap up and it rallied and the market was, everyone was so happy. And we came almost, I think honestly, to the penny. Surprisingly, the penny of, not the daily expected move, but the daily expected move of the VIX. So what I'm going to do here, and you can see a little pressure off to the downside. So was this a face-ripping rally? No, absolutely not. A one standard deviation move, closing up 1%. This was as to be expected from the markets. So if you stick around on today's video, I'm going to be updating you with what the next expected move will be looking like. But before then, I want to hop into this specific chart. This is the chart of the VIX, and I overlay a Bollinger Band on the VIX. Why? It's pointless. Oh my God, you don't use technical analysis on the VIX. No, I'm showing you on the weekly time frame because what I like to do here is I like to look at the width of the Bollinger Bands. Remember, one of the basic principles in technical analysis is stocks, assets, markets, they move between periods of range contraction and range expansion. As you can see, that contracts, it expands, contracts, expands, contracts, expands. Right down here is the line what this is. This is not the VIX. This is the Bollinger Band width. It's measuring the Bollinger Band width. So the tighter, the lower it goes, the tighter the bands are. When it starts to, the bands are, expanded. You can see it's expanded here too as well. Okay, now this was back in March 15th of 2024, and what we called out was, wow, the Bollinger Bands on a weekly perspective, right? We've been talking about, is vol been, suppressed, right? Well, the volatility bands here have been suppressed, the Bollinger Bands on the VIX, to a level that we haven't actually seen since 2007. And this doesn't mean it's going to have the same outcome by any means, right? I can already hear the troll. I can hear your thoughts, right? You're right there. You're watching this and you're like, oh, dude, it's a different time. Okay, no, moving on. Moving on. But what it is telling us is that we could very well move into an expansionary time. And well, I mean, take a look, right? If we zoom in a little bit better over here, you can see that we saw a little burst to the upside. It came in and then we saw a spike. We saw a burst, came in, and then we just recently now saw that spike, right? We expanded in these Bollinger Bands. And what I found very interesting here was, wow, not only did we tighten up the tightest that we haven't seen since 2007, if I bring up a side-by-side comparison, this is 2007 right here, right? This is 2007. This is right now, and this is just look at this part of the chart right here. This is the VIX, and I'm thinking to myself, wow, when we both got this tight on the Bollinger Bands, which we haven't seen right since 2007, look at just how very similar this played out, where we saw this immediate spike that got faded, right? Vol came back in, and then we saw an increase here, and it's actually kind of around the same time period as well, meaning in the year, right? So you can see from July into August, we saw this big spike. And then now from July into August, we're seeing that big spike as well. And I just thought that was pretty interesting. But what got me more interested was actually a chart from Michael Gayad. And we had an interview today. He interviewed me and I talked more about how I approach the market. So if you haven't seen that, I have it on my YouTube, but it's on his as well. But an interesting chart here is it's the VIX that's relative to credit spreads. And credit risk correlates with volatility, as you can see, a positive correlation. You can see that the blue line is the VIX, and then the credit spread is the red line. And what you'll notice here is they move and been moving hand in hand for the most part, but sometimes the VIX has a move prior to the credit spreads. Now, it doesn't mean that it has to respond in a similar fashion, but what he's pointing out here is that we had the move in the VIX and the credit spreads, yeah, they're up a little bit, but they haven't really made its, big advance yet. And if the VIX is going to follow something similar to how it did in 2007, what can we potentially expect? Well, if we go back over here and we look at the same thing, now I'm looking at the VIX is in red. I accidentally switched it, and then the credit spread is in blue. What you'll notice, we kind of pinpointed this time frame of the VIX, how it came up, it came down, and we saw the spike. It's what happened here, and then you'll see that the blue line still kind of continues to trend up, and it wasn't until later that we really start to see things really kind of get crazy. And if I just look more specifically at the VIX, as you can see, we were looking into this area. This is back in 2007. What happened shortly thereafter in 2007 if we're going to follow kind of this same similar path? What is that look and feel going to kind of look like? And what you'll see here is the VIX came back in, and then it shot back up, it came back in, it shot back up, it came back in. And this right here, in my opinion, is some trending volatility. It's holding a higher level than what it's previously used to for some time, and it's causing larger swings in the S&P 500. So if we look at the VIX index right now, and this is on a weekly basis, right, it shot up a lot higher, and now it's just currently at this 28 marker, which the implied move on that is roughly 1.8% on a daily basis up in these areas. What you'll see here is if we do something pretty similar, it could very well chop back and forth and potentially see an elevated VIX for a period of time. And to add another element to this, because, analogs, you can't really trade off analogs, but what they can tell us is how it's happened in the past, and if it's going to be similar, what we could potentially expect. And if I pull up this chart, this is the monthly time frame of the S&P 500. Below us is the US 10-year treasury yield, and then the 2-year curve. And what you'll see is that this curve now is at inverted 9 basis points. That's the closest to being uninverted it's been since going in mid-2022, when basically we just started to get inverted there. And what you'll notice is we were talking about 2007 and 2008. Well, we had a yield curve inversion, and it was starting to uninvert, right, in 2007 and around those times. And over here, this is also the Fed funds rate when the Fed started to cut rates. And you could go back to 2000, right, when we uninverted, right? We were hitting new all-time highs. We uninverted. The Fed started cutting rates, right? The Fed started cutting rates. We uninverted. Even over here, this little tiny inversion over here, it got inverted. The Fed started cutting rates. The markets pressed up a little bit higher, and then boom, they had to step in because obviously the pandemic. And now what are we seeing? Well, we're seeing one of the longest, deepest yield curve inversions for a very, very long time. And we have talks of the Fed going to be cutting rates here starting in September. There's rumors about a speculated early rate hike. I mean, I think that would be crazy, seeing that the S&P 500 is hardly down, right? So, I mean, it's crazy to think that you're above a 200-day moving average. This is a 200 monthly moving average, but a 200-day moving average right now in the S&P 500, you're above, and people are already saying like, oh, we need an emergency rate cut. Like, I'm not thinking that's going to be the case, but I do think that if that is actually the case, things are a lot worse than they actually are, and that would be a problem. So come September, we'll see here if they do take the word of the market, right, and do what the market is really trying to price in here, and that is the beginning of a rate cut cycle. And we got to go only off what we have seen in history, and what we've seen in history, it brings in a lot of volatility in the markets. Doesn't mean it has to play out this same way, but looking back through history, this is typically not a good thing when they start cutting rates. It lets us know that the economy is slowing down. And now they're letting their foot off the gas a little bit, and there's typically a lag. And now if you're wondering like, well, will they even cut rates? Not only if you look at Fed Fund futures, they're pricing it in, but you can look at this chart here. This is the federal funds effective rate, right, in blue. You can see that we're right here at that just above 5%. And then the red line is the 2-year yield. And what you'll notice here is the 2-year yield kind of front runs the federal funds rate. You can see that when it crosses down through it in 2000, that's when we started holding rates to where they were. It started falling more, and the Fed was not too far thereafter to cut rates. Over here, same thing. When the 2-year yield became under, right, the federal funds rate, that's when we started holding rates where they currently were. Over here, the same thing. We crossed underneath it. They held rates. It kept on going down. We started cutting more. And look at us where we are right now. The 2-year yield is heading down as we're moving out of that inverted territory, on the yield curve. And the Fed has yet to actually cut rates, with talks about it taking place, starting to reduce in September, and they're starting to price in a 50 basis rate cut in the Fed Fund futures. So we'll see here how Jerome Powell approaches this as more data comes out. Now, while this is taking place, I do want to look at this specific chart, and this is the 10-year, 2-year yield curve over here. You can see we've been steepening, get around to that uninverted, but I will take note that the 10-year, 3-month, which quote unquote would be the Fed staple, right, the more important one, this is pretty darn far from being uninverted. And this does track, it's been coming off a little bit, but when they cut rates, if they cut rates in September, we'll probably see this dramatically start to move more towards the downside at that point, because this one does really just move hand in hand with the federal funds effective rate. Okay, let's continue on, because we get that out of the way. That's kind of what volatility looked like in the past, what it might look and feel like if we have something similar, if this analog continues to kind of follow its path of higher than normal that we're used to volatility. Let's take a look at the S&P 500, some expected moves. We'll go into some signal charts and so forth. Today we saw a little bit of a bounce, right? We saw a bounce into that daily expected move, back into the lower monthly expected move. We're already trading outside of what was expected for the month in 2 trading days. And we're seeing some very, very large candles. So when I'm looking at this, what am I thinking? I'm thinking that these trends in the very short term have been broken. We're in negative gamma territory. Volatility's increased. This is where you can reduce the amount of positions, or reduce the size that you are, relative into the market. So for example, if you're used to being 100% in exposure, right? There's no reason, because we don't know what's going to happen from this, right? We don't know if this is going to turn into something bigger or not. Even if it bounces up here, is it going to still... You can reduce exposure, and we could really start to hone in when the smaller trends start to change, when we get a follow-through day. If this ends up holding as a low, you'd want to see maybe 6 to 7 days, right? And then you'd want to see a nice big up day with some big volume to really support that this could be the market bottom. I'm saying this because it's not about catching the market bottom or catching the market top. The problem with doing that is you're going to be wrong time and time again. But if you can get out when things start to break, or get in, and not catch the bottom, but get in when you get more substantial confirmations, you can still make a lot of money not catching the exact bottom, say catching, say if this is the bottom and you find more of an establishment up here, there's nothing wrong with catching that, and this thing continues to move higher, right? It's like I said, you're either trying to catch a falling knife or you're trying to get out too early. You got to be just aware of that, and we just don't have the data yet to support it. So if you are swing trading, right? If you're a swing trader or whatever, I'm going to put this in the category of swing trading, it's a time to be incredibly patient with markets in this high turbulence. Now, if you're an investor and your timeline is 10, 20, 30 years, whatever the case may be, you might be thinking completely different, because this fell 15% and you start adding to things. There's nothing wrong with that at all. And you can withstand if the market were to go down further for the most part, right? Because if you're investing, you might just be putting a little bit more in and putting a little bit more in, or whatever the case may be. Now, if we take a look at the 15-minute time frame, we're below a 5-day moving average. So when I talk about trends, this is the short-term trend that I look at. Not to say that we're just under it, but it is trending down. So if we start to get above this, right, this is going to be, tomorrow we're going to get this data. today. So 1, 2, 3, 4, and 5. So starting tomorrow, this data is no longer going to be in the calculation, and it's going to calculate this data moving forward. And then as soon as we lose this data, right, in the next couple of days right here, so if we're going to stay in this range and down here, the 5-day moving average is going to start averaging itself downwards. And perhaps if we do start to move in some sort of a fashion, what you can look for is a series of higher lows to hold and potentially start to coil up within these ranges and then start to break out, flatten out, and start to move back up. There's nothing wrong with that. Even if we see a big breakout day tomorrow, the 5-day moving average is going to still average data that were below it. So it's going to still be kind of declining to potentially slowly neutralizing. And if we drop back down, it could put in a higher low where you can establish a move, something like this, in the very near future. Now, in times of high volatility, which we are in, you can see rip your face off rallies, which was not today, and you can see selling into selling, which we have seen. You may be looking at this now and you'd be like, well, this looks kind of like a bear flag and it's in bearish context. You'd be absolutely right. Even if it bounces up like this, right, you can still potentially say it looks like a bear flag, but you'll be seeing a series of higher lows, right? It's when you start to break down from you see a lower high and then all of a sudden a lower low with the 5-day moving average still trending down is when you would be a lot more cautious. And these higher highs and higher lows, they give us an idea where you can put stop losses if you are trying to manage from a shorter term basis. Now, as it stands, we did tag in that quarterly expected move the prior trading day. I anchored a volume weighted average price to that, and we're still holding above that. So if we come in a little bit, we'd be right at that weekly expected move. So far, the start of this week, we're doing exactly what the market anticipated it to do based off of implied moves. We're inside the weekly expected move at this current moment. Going into tomorrow's trading session, our daily expected move looks like it's 529 and 10 cents and 515 and 20 cents. We are below the flip line still. So when you're below a gamma flip line, this is when times are more volatile and liquidity, it typically goes down. So selling into selling, buying into buying. So we need to pay attention to various gamma levels because they can act as levels of interest. And one of the levels right here would be 5,200. You can see that we came in this one today. We saw a nice little thrust from that into what? 5,300, another kind of round number, which happened to be a gamma level too. And price started to repel from that level. Okay, so within this range is a lot of gamma. We're kind of just getting pinned in and around this range. I'll be updating this chart probably tomorrow once again and putting it in the Discord and so forth to see kind of where things are and load some 0-date levels too as well. But right now in this current moment, the gamma flip line is 54.60. If it updates, it might come down a little bit lower. And that's what we really got to pay most attention to as a swing trader to know when volatility may start to subside a bit and when obviously we start to trend potentially back up to the upside. And then we keep watching it from that standpoint. Now, going into tomorrow's trading session, this is what it looks like for the SPY for a 1 standard move and a 2 standard deviation move, right? Remember, we showed you this on yesterday's brief, and this is what it ended up doing. Now, it's not always this accurate, and I know the very first thing people are going to think is, I'm going to short right here, or if it goes down here, I'm going to buy. It can break these levels. This is just an idea for risk. So what you could do, and I've done many times, is you can start with a 5-minute opening range, or a 15-minute opening range, or a 30-minute opening range for all of that matters. Whatever your opening range is, say if you open, which we opened up right here, this is a 30-minute candle, all right? And then we close right here, and you might say, okay, if I break out of this opening range on the 30 minutes to the upside on the next candle, I'm going to go long into that implied move. That would be a trade idea, right? If you're day trading, you can add other elements to this, like market net flow. If you're in the Discord, you'll have access to that in the query channel. You can look at it and see if it's in a bullish flow or whatever the case is. Sometimes I use it on my lives, but that's one way, right? Or you can look at a minute opening range, a 30-second. It don't matter. You can do whatever works best for you. Sometimes we gap above the opening ranges, or not the opening range, gap above the daily expected moves or below it, and sometimes this flips and ends up being more of a level that we repel from more to the upside. And if that's the case, you can start looking at 2 standard deviation moves. So this is what the ranges kind of look like for tomorrow. You can just go out to the left. It's about 532 to the upside, about a 513 to the downside, and you have your 2 standard deviation move there. Now I want to get into some signal charts and kind of walk you through, like, are we going to see potentially more downside? Are things getting a little frothy? And there's mixed signals, right? So if we look at the bullish percent index, this is for the COMPQ, the NASDAQ composite. And you can see that after this sell-off took place, the RSI is getting a little fried. It's not really a low reading on the bullish percent index, but the RSIs are getting a little fried. So bullish percent index for the NASDAQ composite. For the NASDAQ 100, there's actually a positive divergence here. So we had a low, we have a higher low on the RSI, we have a low and a lower low reading, one of which we haven't really seen since April to May of earlier in the year of 2024. Then prior to that was in 2023, and both marked pretty decent bottoms. So we're seeing a positive divergence. We're seeing it kind of extended to the downside for the NASDAQ 100. So I'm thinking maybe if we do bounce, we can see some moves in tech. That doesn't mean we're out of the water if we see a bounce, but it's a possibility. A bullish percent index for the S&P 500 is also moving to that oversold territory here too, and it's the lowest reading that we've seen since 2023 on the specific sell-off. The Dow Jones Industrial Average Bullish Percent Index, right? That one's getting pretty frothy to the downside. Looking at the RSI, it's not the lowest reading, but it's the lowest dating back to 2023. The New York Stock Exchange Bullish Percent Index took a quick hit, and this is the lowest since we've seen since 2023 here too as well. And the RSI is actually putting in a positive divergence in this current moment, as you can see right there. The bullish percent index for the S&P 100 just now moved into oversold conditions as well. The bullish percent index for the technology sector, more specifically, does not have the positive divergence, but you can see that it is getting an extended reading to the downside in areas, kind of a range dating back to around 2023. Now in 2022 bear market, things got a lot more extended to the downside, but we're getting a low reading comparatively in the last year, 2 years, a year and a half, whatever the case may be, and we're getting an RSI reading that's pretty frothy. The discretionary sector bullish percent index, also same things, been getting crushed. RSI moving into oversold conditions. The energy sector is quickly moving into oversold conditions. The financial sector is quickly moving into oversold conditions there too as well. Now, like I said, there are mixed signals. So if you look at the percent of stocks above the 20-day moving average, which is more of a medium-term to short-term moving average, you can see the various index, so NASDAQ, NYSE, NASDAQ 100, Dow Jones. Typically, when this is an oversold condition, it's like a reading like in around 15. And you can see, yeah, with this sell-off, you can see all these index products, right? The percent of stocks in all of these names, they have gone down, but there's nothing actually really too extreme. We did tag in the NASDAQ composite as an extreme that we haven't seen since in April, which marked a pretty nice little bottom there. But everything else, for the most part, it's not really overly extended. I think that the move down was frothy, but we're not like necessarily like burnt to a crisp extended there. And then if we look at the percent of stocks for the NASDAQ 100 that are above the 50-day, above the 200-day, these came off quite a bit. And we've been talking about this divergence that's been building, how the market was pressing higher, how less stocks were participating. And what do you think happens? Things eventually regulate. They fix themselves some way, some shape, right? Whether that's more names go to the upside and it resolves up, or it resolves itself to the downside. And if I look at this is also not really too extended, right? The percent of stocks in the NASDAQ 100 that are above the 50-day, they've been falling, but not to a level that is really too concerning. And then the 200-day, it's the lowest reading that we've seen since this move down here in 2023, but it's really nothing like overly crazy where like we've seen in October of 2022. So that's what I kind of mean of mixed signals. Another cool indicator here is looking at, it's called the full indicator. This is taking the NASDAQ composite and dividing it into the total put to call ratio, which is that purple shaded line in the background. But to smooth it out, we use a couple EMAs, 21 and 50. And when the 21 crosses above the 50, it's that green line, right? Boom, boom. Those are buy signals. Red ones, it's the red signal. And, I'll walk you through a couple. This is a very lagging indicator, but sometimes it identifies big changes in trend. One of the most recent ones, right back in August of 2023, it was that right there crossed over and we saw the market go down. We saw a big rally up. It came back down. It rallied up. It came back down. And it wasn't until about here where it started to cross back over, and that led to a nice rally before running into the next sell signal. But the more light, it was kind of choppy back and forth. And we saw some activity there, and it wasn't until recently on that another one gap up, we had more of an established buy signal, which was recent. And then just now recently, we had these cross over to create a sell signal. And that doesn't mean, hey, the market's going to go straight down. We could very well see something very similar, right, where it snaps back up and maybe this still continues to trend down like this, letting us know that, hey, this move can potentially get faded. And if it does, we may be looking at various different topping patterns from that point. Now, another signal chart that you could potentially use, very easy, it's the 5, 10, 20 timer. And this allows you to see when the trend kind of resolves itself. And you'll see the 5, 10, 20, these are the EMAs. The blue, when you're in a positive trend, you're the blue above the red, above the green, right? That's 5, 10, 20 stacked. And it's not until they start to get pretty tight that you got to be a little bit more cautious. And then when they all stack against each other, where the blue is below the red and the red is below the green, that indicates the time to potentially watch out, and we could be trending to the downside. So you can see that this was the sell signal. Just mark it right over here, right in around this range. The buy signal was pretty much right around this range, and it held all the way until this point right here. And you can see from that standpoint, we have seen increased volatility. We've seen the trend start to continue to the downside, right? It was a time to be cautious when they were all converging here, and we saw follow through to the downside. I didn't predict that this kind of move would happen, but it at least gave us insight that something could very well happen and to be prepared for if something actually does. So what you could wait for is the volatility to subside, and it may take time, and the moving averages might take a while to start to come back and to converge and start to cross back up and give us a more specific entry based off of just this simple market timing tool. All right, let's go now into Thinkorswim, and we'll look at some of the larger market cap names. First and foremost, we'll take a look at Apple. Apple on the daily time frame, we saw that big breakout here. We saw some nice consolidation, and we saw follow through, and now it's coming back in. Today, Apple was on the downside, but it really was just an inside trading day. So volatility expanded. Now it's starting to contract a bit. I'd be just watching this carefully, maybe go into the 15-minute time frame. You can see that it's still below a declining 5-day moving average. It's not necessarily something I want to trade to the upside. A lot of people are very interested in catching the bottoms. If you're doing that from a daily basis, you want to look at these, the higher lows, but the lower highs as well. So if you start breaking above, maybe that will identify an area to put a stop. Okay, and then maybe you can trade it up and update your stop as time progresses. But remember, if it keeps on going like this, there can also kind of be flagging in a bearish trend. And you got to be aware that when it starts breaking a lower high, breaking a higher low, that's a time to proceed with some caution. Take a look at Microsoft's also still in that downtrend, and this one's gotten cracked pretty hard here for looking at the daily time frame. So yeah, obviously people are going to look for the market to bounce, and it very well can, but just be prepared for sloshing volatility. So if if the 5-day moving average, right, starts to flatten out here in the near future, and this starts to kind of catch some momentum, start to get up to 420, 425, whatever the case may be, when you look at the daily time frame, right, and you're thinking like, hey, I'll buy it here and I'll just hold it here in the midst of volatility. Well, say if it does come down and bounce back up to 420 or something like that, catching this move here, right, in this area to play it back up to 468 it's just still a really good move. But coming down here, it would obviously make you more, but you don't necessarily have the trend on your side if you're trying to do it early. So you need to be really considering from a swing trading perspective whether that's the smartest move for you. Or if you're an investor, maybe you look at this and you're like, I just buy when things are down this much, and then maybe that's a whole different story, right? It fell 20% in a very short period of time. NVIDIA too. I mean, some of these names, they went hyperbolic, crazy, right? Like, and they've gotten so extended for the most part. Maybe not even the words right to use extended, but euphoric, right? And then we starting to see things kind of more specifically larger range candles, which is more volatility. So when I look at this, I know that we have earnings around the corner. I know that the volatility can take this thing back up, and I know the volatility can take us down even further. So I'm not really looking at this to swing trade yet until things start to tighten up and give us more insight. Like, look at how this got tight here above these moving averages. That right there was good looking charting at the time. And then here it's like, man, like things are in this expansionary kind of range, and you got to be much more cautious. 5-day moving average, right? If you're trying to look for higher lows, it's still down. It's trending down. You can see we've been respecting it for the most part. We got above it a few times, right? Above it, but it came above it while it was still declining, which is a warning sign. So what happens? If you buy it and you don't have a stop in place, you can get pretty much thrashed. So when it gets above, what you want to see is price to trade around these areas, start to put in higher lows, start to break these highs, give us an idea for risk management, and this 5-day moving average to start to turn back up. Google also has been getting crushed well below the 5-day moving average. Same thing, right? We got above it a few times. It started to flatten out here, but you got to respect those breakdowns if you're trying to approach this a little bit more tactically. You can see here we're still above a rising 200-day moving average, and we're getting some wide swings. These are both inside trading days as it stands. So if it comes back in, it's not necessarily down and out fully, but we're seeing volatility, and it's always worth considering different ways of strategizing to be tactical in this environment. Amazon reported earnings. This saw some pretty massive blow to the downside. And like these swings, these candles are quite impressive. You're seeing big moves and people want to catch bottoms. I get it. But also, if you're trying to catch bottoms, remember at bottoms, there's typically more volatility. That's what capitulation is. You'll see more volatility. So you don't need to have full size position to try to catch a bottom, because if you go full size, say if this day you went full size and it went all the way up here and you're like, say if you caught the bottom right here, and that day, and you caught all the way up, and you're like, you're killing it. And then all of a sudden you open down here, that would probably scare the living bejeebus out of everybody who took that specific trade if it's oversized, because you just watched yourself feel really happy to being down almost 10% the next day in a big oversized position. But if you start small, and while volatility starts contracting, and doing whatever it has to do, regulating higher highs, higher lows, you can add in more strategically and pyramid into the position if it's actually working in your favor. Take a look at Meta. Meta is more just kind of in this range bound here. It had earnings. It liked them. It gapped up. Then we saw some follow through massive to the downside. We saw some follow through back up to the upside. This is a big chop fest in Meta. Could be a period of distribution, right? Where we're seeing some days, you're seeing some pretty heavy volume to the downside. So I'd be cautious in this area, but this one is actually above a 5-day moving average, and it is actually inclining. So what I look at here is, okay, if you're long Meta, a stop down here from 450 to 494 or wherever the entry might have been. That's if you're like entering right around here. That's kind of crazy, but I would say maybe right here, right? That would be that higher low that kind of flagged out. This day we saw a move, or wait to see how tomorrow pans out. Maybe we get a gap up. Maybe it pulls in and then all of a sudden it puts in a higher low, and then it starts breaking from this pattern, something like that. And this starts to continue up. Okay, maybe that might be more of an opportunity. Overall, we're just kind of trading sideways as the 5-day moving average is trying to regulate. All right, so today's episode went a little bit longer than I expected, but man, we went over a lot of stuff, from how volatility looked like back in 2007, what that might look and feel like today. We discussed, obviously, mega cap stocks, a lot of signal charts and gamma levels in the current market conditions and how to navigate them. I hope today's episode helped out everybody. I'll see you on the next one. If you haven't done so already, please make sure to subscribe and hit that like button. See you later.